Hello, everyone, and welcome to TSAM Digital. This is Ana Luisa, and today I am joined by Ezekiel Machabansky, the head of financial modeling for Orenda Software Solutions, a SIX company. Welcome, Ezekiel.
Thank you. Thank you, Ana.
So, Ezekiel, could you tell us a little bit about yourself, your work, and the company?
Absolutely. My name is Ezekiel Machabansky. I'm head of financial modeling at Orenda Software Solutions, a SIX company. I joined the company about 4 years ago, and my core mandate is to create quantitative models or financial models, as well as applications for our unique ESG data set. The company was founded in 2015 by Tanya CJ, and we report ESG performance data from the lens of society.
Amazing. So, Ezekiel, which desks within a financial firm would be most interested in receiving the ESG performance data, and why?
I think we can start with compliance, given the nature of its mandate. As protectors of the firms, I think they're naturally interested in employing data sets that will allow them to qualify investment vehicles prior to research or front office taking over. And speaking about research, and I think that I can't emphasize this point enough, that irrespective of research methods employed at firm level, either purely quantitative or purely fundamental or a mixture of quantamental approach, I think that ESG performance data can and is employed in each one of these methods. For example, our performance data can be introduced into multi-factor models very easily. Fundamentally speaking, we have found strong correlations between good ESG scores and fundamental value as well. And last but not least, in bringing the quants back into the answer, they are in need of high frequency performance data to make rather rapid trading or investment decisions. And I think that our offering actually solves each one of these needs or problems.
So why should a firm choose SIX ESG data, either instead or in complement to other traditional ESG providers?
This is indeed a great question, and it's one of the several questions that we get often repeated and asked. I think that one of the several value propositions that in our offering is the ability to reconcile a traditional and perhaps one-sided ESG reporting to what society reports back. Traditional ESG data providers, collect input from corporations that sometimes treat ESG reporting as merely a marketing exercise. I never heard of a corporation reporting on poor ESG metrics or performance. So our offering reports directly through the lens of society. And what I mean by that, it's all stakeholders, employees, consumers, investors, everyone. So it's a democratic way to actually report on ESG metrics. As you can imagine, sometimes these two reporting methodologies present gaps, right? Like people see or perceive the actions of corporations differently to what the corporations are actually reporting on. So I believe that the optimal value is derived when investment decision makers, they take a look at both ends of the equation, and either they can confirm what corporations are saying by looking at what society is saying, or basically investigate when both of these reports are, offering opposite views, which, by the way, that creates an opportunity by itself, right? So I believe that this is, it's a crucial step for an efficient and successful ESG investment strategy.
So, Ezekiel, how big of a role do you see regulations playing in the area of ESG currently and going forward?
I think that traditionally in capital markets, when we hear the word regulation, I think the first natural reaction is to reject it. However, in this particular case, the markets are asking for it. I think that we all are asking for a harmonized regulation that will streamline regulatory process and ESG data reporting, right? So we're actually welcoming it. And although there will be an adjusting period, there will be an adjusting period for all capital market participants. I think the regulation will pave the way for a continuous and robust inflow of investments in the ESG space, which is what we're all looking for.
How important is timeliness of ESG data, since traditionally this is a fairly static data set?
Timeliness. So if we look at timeliness in capital markets as a whole, right, most of us will say that it's absolutely crucial to be at the right time. But now when we reference ESG data, this is significantly more important because having access to timely ESG data could be the difference between having a portfolio holding true ESG assets versus assets that are completely deficient in terms of ESG practice, right? And what's worse, it could be for a prolonged period of time because, as we all know, when ESG data is reported, traditionally, every 6 months or every 12 months, or traditional news feeds actually come out and expose ESG deficiencies, I think it might be too late for portfolio managers, perhaps. And not to even mention the potential economic loss that could be derived from solely employing infrequent ESG data sets, right? So I think that given the high frequency feature of Orenda 6 ESG performance data, this problem is solved at heart and very, very efficiently.
So do you feel financial institutions are deploying ESG strategies mainly for compliance purposes or performance opportunities, or both?
I think that at this particular stage, most firms are seeking compliance, not necessarily performance. However, I think we're also witnessing a significant shift for reasons such as timeliness of the data. They also see huge value in terms of deploying the data for portfolio construction, portfolio optimization, and also alpha generation, right? Historically, ESG data has been disassociated from alpha generation. And I think that now portfolio managers and research teams around the globe, they're actually recognizing the value of ESG performance data as a significant source of alpha generation. So that's mainly what's actually causing this shift in terms of solely looking at ESG data for compliance purposes rather than performance purposes.
And how strong are ESG scores in predicting performance, and what industries are they most effective in predicting performance?
So we have tested our ESG products by introducing them into different models and applications. For example, we have constructed portfolios comprised of top tier or good ESG companies from all sectors covered within a particular index or a particular benchmark. And simultaneously, we also build portfolios with extremely poor ESG stocks. And what we have found is that the top tier ESG portfolio not only significantly outperform the poor or the bottom tier ESG portfolio, but you also outperform the predefined benchmark. And I think I'm going to get a little bit more technical here, but one of the things that we test for, it's called empirical alpha. So basically what we do is we look at our ESG factor and we say, does the ESG factor really produce alpha? Or is the alpha or the excess returns being driven by other factors like size or value? These are traditional factors that the market is used to employ in their own investment strategies. So what we do is we control for these factors and say, after taking these widely employed factors into consideration, does our ESG factor still produce alpha? And I'm very happy to say that it does at a very high confidence level. So the empirical alpha, it is statistically meaningful. So with this exercise, what we have found is strong empirical evidence that ESG performance scores can be strong predictors of future financial performance for companies. And we have seen very consistent and similar results across different sectors as well.
Thank you so much, Ezekiel, for this wonderful overview.
Thank you, Anna.